This is your LMAX Exchange technical update for Tuesday, March 21st, 2017. Euro dollar. So the euro is seeing a nice little bounce over the past several sessions, but overall here the downtrend, the longer term downtrend remains intact, and the question right now is whether we're seeing a bearish consolidation roughly between the 103 to 109 area, or if the market is trying to carve out a more meaningful base in favor of significant upside ahead. Right now, the meaningful base argument is winning out a little bit with the possible formation of an inverse head and shoulders on the daily chart. The right shoulder looks to be taking form, and if we see a break above 108.75, the December peak, that will do a good job of triggering this formation, opening the door for an acceleration, potentially up towards a measured move in the 114 to 115 area. At the same time, if the market is unable to establish above 108.75 over the coming sessions and rolls back over below 105, this would suggest that the market is seeing a bearish consolidation on this longer term chart in favor of what could be the next major downside extension back below the current 17-year low from 2017 in January around 103.40 and down towards parity further down. So again, we remain in this sort of critical range right now with the euro, but we are seeing this possible inverse head and shoulders formation, which does suggest the market wants to accelerate over the coming sessions towards a retest of that 108.75 December 2016 peak. Sterling dollar. So cable saw a nice rally over the past several sessions, but as we talked about in Monday's update, the market was coming into some really good resistance into the 124 to 125 area, and so the market was well capped in favor of this latest bearish reversal. Overall, the risk here does remain on the downside, even if we see another push higher, with rallies expected to continue to be well capped in the 125 area in favor of that next downside extension back towards a retest of the 2017 low at 1987, which guards against the more significant multi-year base from October 2016 at 118.41. In order to see a meaningful shift in this structure to the top side, we would need to see a break back above the December 2016 peak at 127.75. Dollar yen. So dollar yen has been confined to a consolidation over the past several weeks, defined between 115.62 above and 111.59 below. But after seeing the market top out earlier this year, there is risk that this consolidation could be a bearish consolidation in favor of the next major downside extension below 111.59 and down towards a measured move into the 107.60 area, or to the 107.60 to 108 area by that measured move and 200-day SMA, which comes in just over the 108 barrier. And so there is risk here for a significant downside if we do take out that 111.60 range low. Until then, the market is playing this range, but any rally should continue to be very well capped ahead of 115.60, with only a break back above that 115.62 high to compromise what is overall right now a bearish outlook for dollar yen. Euro Swiss. So Euro Swiss has mostly been confined to a downtrend over the past several months, and any rallies that we do see in this market are very well capped, most recently above 108, and so a fresh lower top is sought out ahead of the next major downside extension below what has been a bit of an elusive test of that 106.24 2016 low. But a break below that low will expose a fresh downside extension in this market, which could take us down towards and below psychological barriers at 105. We would need to see a break and close back above that recent high at 108.26 to take the immediate pressure off the downside and suggest a more significant reversal in this structure. Aussie dollar. So Aussie has seen an impressive rally in 2017 that has yet to stall out. It looked like the market was wanting to stall out several days back in early March, seeing that breakdown all the way down towards the 75 area, but we've since seen a rebound all the way back to fresh 2017 highs above 77. Overall, there is some significant medium-term resistance in Aussie dollar up towards 78, and so the risk is that the market will continue to be well capped in favor of a resumption of declines that could take us back down towards the 70 barrier. But at a minimum right now, we would need to see a break back below recent support around 76.60 to officially take the pressure off the top side and accelerate declines. dollar CAD. So dollar CAD has been consolidating its latest decline after the market had rallied up just shy of some key multi-day highs up around 136. At this point, the overall structure continues to favor the top side, though we are in the middle of a range here, and so there is risk for a bit more downside before we see the market push higher. Any setbacks are expected to be very well supported in the 131.50 to 132 area, with only a breakback below the recent low that we saw this year at 29.69 to negate the overall constructive outlook. Ultimately, we should see a break back above that recent high that we saw all the way up around 135.35, then exposing that multi-day peak around 136 and opening the door for the next major upside extension towards the 140 area. Kiwi dollar. So Kiwi gains have been capped thus far over the past several hours, with the market pushing up back above 70, but having some strong resistance ahead of 71. This is a market that has been showing signs of topping out since 2016, and so rallies are expected to be well capped. Ultimately, if we do see this market push higher over the coming sessions, again, we're coming into some key resistance into the 71 to 72 area, which should cap in favor of that next downside extension towards medium-term support around 68.60. SPX 500. The S&P 500 has finally stalled out after consistently posting record highs in 2017, and over the past several days we've seen a bullish consolidation. The market is classified as a bullish consolidation as it holds above 2350, which ultimately could result in a fresh upside extension beyond 2400 and towards the 2450 to 2500 area further up. However, given the longer term technicals that are quite stretched, there is the possibility for a bearish reversal and a structural shift, though we would need to see a daily close back below 2350 to suggest that we are seeing such a reversal. Gold. So gold continues to show signs of major base since bottoming out in 2016 ahead of key psychological barriers at 1100. We've since seen the formation of a series of higher lows and higher highs, and so this latest round of setbacks have been very well supported just under 1200 in favor of what could be a next higher low around 1195 ahead of that next major upside extension beyond the recent highs that we saw at 1264 and towards and through 1300 further up. At this point, only back below 1180 would compromise or delay the current bullish outlook for gold.